$3 trillion. That's the size of the United States insurance industry, bigger than the entire economy of France. One company alone, UnitedHealth Group, collected $447 billion in revenue last year. That's more than the GDP of Norway, Denmark, or Singapore.
Wait, 447 billion from one insurer?
One insurer. And here's the part that should stop you in your tracks, Avery. The average American family is now paying $27,000 a year for employer health coverage, $6,000 a year for homeowners insurance in Florida, and watching their auto premiums climb every 6 months. And nobody talks about this as a wealth issue.
But it is a wealth issue. That's $20,000, $30,000, $40,000 a year leaving the household. Money that could have gone into a 401k, a Roth, a down payment.
That's the whole game. Insurance is the quietest, most relentless wealth extractor in American life. And today, we're going to talk about how it got that way and what you can actually do about it.
Okay, so today we're talking about the insurance industrial complex. Health, home, auto, the three lines that touch every American household every single month. We'll cover how it started, how it got this big, why it feels so broken right now, and the wealth moves that work in 2026. But before we go forward, we have to go back, way back. Because the story of American insurance starts with a guy you've heard of, and a fire that didn't happen.
Let's get into it. 1752, Philadelphia. A volunteer firefighter and printer named Benjamin Franklin gathers 70 of his neighbors at the courthouse and proposes something the American colonies have never had before: a mutual fire insurance company. They call it the Philadelphia Contribution Ship for the insurance of houses from loss by fire.
The contribution ship, like contributing to a common pool?
Exactly. The Latin motto on the seal said, "Without the Lord, we can do nothing," and the symbol was 4 hands clasped together at the wrist. People started calling it the hand in hand. The deal was simple. You paid a premium, the company inspected your house, and if you had brick walls and no trees out front, they'd cover you against fire.
Wait, no trees? Why no trees?
Franklin was an actuary at heart. Trees burn, so the contribution ship refused to insure any house with a tree in front of it. And in 1784, a rival company opened up across town. They called themselves the Mutual Assurance Company, but everybody knew them as the Green Tree, because they would cover your house with the trees.
So the very first competitive fight in American insurance was over landscaping.
Over landscaping. And here's the beautiful part, Avery. The Philadelphia Contribution Ship still exists. 274 years later, it's still selling homeowners policies. But that's the property side of the story. The health side starts almost 2 centuries later in a hospital in Dallas that was about to go bankrupt.
Bankrupt? In what year?
1929, the same year the stock market crashes. Baylor University Hospital in Dallas is hemorrhaging money. Their revenue per patient has collapsed from $236 down to $59. They're weeks from insolvency. So Baylor hires an executive vice president named Justin Ford Kimball, former school superintendent. And Kimball goes through the books, and he notices something specific. A huge chunk of the unpaid bills are owed by Dallas public school teachers.
Teachers couldn't pay their hospital bills.
They couldn't. Wages were collapsing, the depression was just starting, and a hospital stay would wipe out a teacher's savings. So Kimball pulls out his calculator, figuratively, and he runs the math. He divides the hospital's annual expenses by the number of teachers in Dallas. The number comes out to about 15 cents per teacher per month. He triples it for safety. He rounds up to 50 cents.
50 cents a month.
50 cents a month, $6 a year for up to 21 days of hospital care at Baylor. He calls it the Baylor Plan. He goes to the school principals, then the teachers, and within weeks, more than 1,300 Dallas teachers, about 75% of the district, sign up. And then, Avery, this is the part I love. The very same week the plan launches, December 1929, a Dallas teacher named Alma Dixon slips on a patch of ice and breaks her ankle.
No.
She becomes the very first patient ever hospitalized under group health insurance in America. Her bill gets paid by the plan. Word spreads. Teachers start signing up in other cities. The American Hospital Association picks it up. By 1933, a Minnesota administrator named E.A. Van Steenwyk designs a poster with a blue Geneva cross, and the name Blue Cross sticks.
So Blue Cross, the giant, started because one woman in Dallas slipped on the ice.
The history of American health insurance is really the history of one slip on a patch of Dallas ice. But here's what changes everything, Avery. World War II. The federal government freezes wages to stop inflation. Companies can't compete for workers by paying more, so they start competing by offering health benefits. The IRS rules in 1943 that those benefits aren't taxable. And just like that, American health insurance becomes employer-sponsored, which is where almost 150 million Americans still get it today.
So the entire structure of American healthcare, tied to your job, the second you lose the job, you lose the insurance, that wasn't designed. It was an accident.
It was a tax loophole that became a system. And a system that became a complex.
Sounds familiar.
So let's bring it up to today, 2026. The U.S. insurance industry is now valued at over $3 trillion in annual premiums. Health insurance alone is over $1 trillion. Property and casualty, that's home and auto, is close to $1 trillion more. Life is the rest. Let me give you the numbers that matter for households. Family employer health coverage in 2025, $27,000 a year. Single coverage, $9,300. Both up around 6% year over year, outpacing wages.
$27,000 a year. That is more than a lot of families pay in rent.
Now look at homeowners. National average for $300,000 in dwelling coverage, $2,100 to $2,400 a year. Florida, $6,000 on average, up 200% since 2019. California, climbing fast, with 7 of the top 12 insurers having paused or restricted writing new policies. State Farm, Allstate, Farmers. In Florida, the state-backed insurer of last resort, Citizens, has tripled its policy count in 4 years. In California, the FAIR plan is up 137% since 2019.
So in the two biggest disaster states, the private market is collapsing back into the government plan.
That's exactly what's happening. And auto premiums grew so fast in 2023 and 2024 that the Bureau of Labor Statistics flagged it as a major inflation driver. They've cooled a bit in 2025, but the average full coverage policy is around $2,100 a year, and in Louisiana, it's nearly $4,000. Here's the household math, Avery. Add a family health plan, a Florida home policy, 2 cars, you can be at $35,000, $40,000 a year on insurance alone before a single dollar goes into savings.
That's a Roth IRA contribution times 5.
That's the wealth extraction. Quietly, monthly, forever.
Okay, but Grant, let me push back. Because I'm sitting here getting outraged. But we have to be honest. Insurers aren't just sitting on a Scrooge McDuck money pile, are they? Some of them are actually losing money.
You're right to push back. And this is the balanced view we always do. Let's give the insurers their fair shake. Here's the steel man. UnitedHealth, the giant, collected $447 billion in revenue in 2025. Their net profit was $12.1 billion. Sounds enormous, But do the math. That's a 2.7% net margin. That's lower than Walmart, lower than most grocery stores.
2.7%? On almost $500 billion?
2.7. And their medical care ratio, the percentage of every premium dollar that actually goes to paying claims, was 89% in 2025, up from 83% 2 years earlier. Why? Because medical costs are rising faster than premiums can keep up. Hospital coding intensity, GLP-1 drugs like Ozempic, specialty drugs, and aging population. The insurer is squeezed in the middle.
So the 80-20 rule actually worked, in a way?
Sort of. The Affordable Care Act, passed in 2010, created the medical loss ratio rule. 80% for individual plans, 85% for large group. If insurers don't spend at least that much on actual care, they have to refund the difference to policyholders. Since 2012, that rule has returned about $12.7 billion to American consumers. Last year alone, almost $1 billion in rebates.
That's real money.
It's real money. And on the property side, climate is the steel man for the home insurers. 10 of California's 20 largest wildfires have happened in the last 5 years. Florida just had 3 major hurricanes in 2 years. From 2018 to 2023, insurers canceled nearly 2 million homeowner policies, 4 times the normal rate. Allstate, Progressive, State Farm, they're not getting rich on California homes. They're trying to stop the bleeding.
So the squeeze is real on both sides. The household is paying more, the insurer is paying out more, and we're all kind of stuck in the middle.
That's the honest picture. The bad news is the system is genuinely strained. The good news, the one we always come back to on this show, is that there are specific, concrete moves a household can make to claw back thousands of dollars a year. So let's get into them. 5 wealth moves on the insurance industrial complex.
Let's do it.
Move number 1, shop every renewal, every line, every year. The single biggest mistake American households make is auto-renewing without quoting. Industry data shows that people who shop their auto and home policies every renewal save an average of $300 to $700 per line. Use the comparison sites, Insurify, The Zebra, Policy Genius, or call an independent broker. The new customer always gets the best rate.
Loyalty in insurance is taxed, not rewarded.
Loyalty is taxed. Move number 2, raise your deductibles strategically. This one is huge. On home insurance, going from a $500 deductible to a $2,500 deductible can cut your premium 15 to 30%. On auto, raising from $500 to $1,000 can save 10 to 15%. The catch, and this is critical, Avery, you only do this if you have an emergency fund big enough to cover the higher deductible. Otherwise, you're trading a guaranteed monthly cost for a financial cliff.
So this is a callback to episode 8. The emergency fund unlocks the deductible move.
Exactly. The bigger your emergency fund, the more you can self-insure the small stuff and save on the premium. Move number 3, claim the rebates and discounts you've already earned. Most people have no idea their insurer might owe them money. Check your medical loss ratio rebate every August. Your insurer is required to notify you by August 1st if you're due one. On the property side, every major insurer offers mitigation discounts, impact-resistant roof, storm shutters, a new water heater, a security system, smart smoke detectors. Some carriers will knock 15 to 25% off for a roof upgrade.
So the policy you already have probably has hidden savings in it.
It probably does. And nobody's going to call you up and offer them. You have to ask.
Of course not.
Move number 4, cover the catastrophic, not the small stuff. This is the most important wealth principle in insurance, and almost nobody follows it. Insurance is for things you cannot afford to absorb. A house burning down, a $1 million lawsuit, a breadwinner dying, a $60,000 hospital stay. That is what insurance is for. It is not for replacing a phone screen. It is not for a $500 fender bender. It is not for an extended warranty on a toaster.
So you're saying high deductible, but big coverage limits?
That's exactly what I'm saying. On auto and home, raise deductibles, but raise your liability limits. $300,000 minimum, ideally $500,000. And add an umbrella policy. A $1 million umbrella policy costs about $200 to $300 a year and protects everything you've built. On life, if you have dependents, get term life, 20 or 30-year level term. A healthy 35-year-old can get $1 million of coverage for around $30 a month. Skip whole life, skip universal life. Those are investment products dressed up as insurance.
Term life, umbrella policy, high deductible, big limits. Got it.
Move number 5, and this is the one nobody talks about. Aggressively appeal denied claims, especially health.
Appeal them?
Appeal them. The data here is wild, Avery. Studies of ACA marketplace claims have found that about 1 in 5 in-network claims gets denied, and of those denials, fewer than 1% are ever appealed by the patient. But of the appeals that are filed, somewhere between 40 and 60% get overturned. The system relies on you not pushing back. You always have the right to a written explanation. You always have the right to an internal appeal. You almost always have the right to an external review. Use them.
So insurers are denying 1 in 5 claims and 99% of people just pay without question.
Without question. And the insurer is counting on it. If you get a surprise bill or a denial, call the insurer. Ask for the specific policy reason. Request the internal appeal in writing. And if that fails, file the external review with your state insurance commissioner. It is not fun, it is not fast, but it is the single highest return hour of paperwork most people will ever do. Avery, here's what I want listeners to walk away with. 274 years ago, Benjamin Franklin and 70 of his neighbors put their hands together, literally 4 hands clasped on a seal, and said, "We will share the risk so that none of us is destroyed by it." In 1929, Justin Ford Kimball looked at unpaid hospital bills from Dallas teachers and said, 50 cents a month and we'll all be okay. Those were good ideas, born from genuine community. The Hand in Hand, the Baylor Plan, the Blue Geneva Cross.
And somewhere along the way, it became something else.
It became a $3 trillion industry that quietly extracts $30, $40, $50,000 a year from working households. And most people never even notice because it leaves their paycheck before they see it. But the original idea wasn't wrong, Avery. Pooling risk so a single fire, a single accident, a single illness doesn't destroy a family. That's still one of the most powerful financial tools ever invented. The job of every household in 2026 is to use the tool, without being used by it.
Insure the catastrophic, self-insure the small, shop every year, appeal every denial, and never confuse insurance with investing.
Preparing without predicting. Always.
That's Trek4Wealth. Keep trekking.